Well, good morning again, everyone. Thanks so much for tuning in. Well, Michael Burry's latest 13F filing certainly gave many YouTube finance channels fodder for some more scaremongering about the impending collapse of everything. Did Michael Burry just bet on America's crash? Game over. Michael Burry 2022 final crash and recession warning. Michael Burry just bet all in on a global financial crash. Or Michael Burry selling everything, final warning to investors. Or Michael Burry, the big stock market crash is imminent. Well, yes indeed he do. He did sell all of his holdings during QT, but then did buy another new position, namely GEO Group, ticker code GEO, a company that provides enhanced in-custody rehabilitation, post-release support, electronic monitoring and community-based programs for people who have been imprisoned. But it's only a $3 million position, which is a pittance compared to the total value of the portfolio. The big question that interests me, however, is why did he sell his largish short position in Apple if he thinks big tech is going the way of the Titanic along with the rest of the market? Now, as it turns out, that decision was quite prudent because Apple has rallied 32% in the last 2 months. Another question worthy of some thought is what is he doing with all the cash that he's got now available for him to deploy? Anyway, you can't argue with the fact that at some point during the period April 1st through to June 30, he decided to take almost all of Scion Capital's money off the table. We won't find out for at least a few months whether he shorted the market or any individual stocks during Q3. And while all this is going on and exciting content creators, Warren Buffett just plodded along as usual, tinkering around at the margin with a few of his positions, and so he's not seeing any reason to take a sizable portion of the Berkshire portfolio to cash just yet. But as for Burry, we won't know what he's been doing lately either until his next 13F filing is released. So for us mere mortals, this really is just all noise, and we have to navigate our way through earnings reports, outlook statements, geopolitical tensions, and economic forecasts by supposed experts who are wrong as often as they are right. Perhaps Burry's analysis will prove to be correct, but there is no guarantee of that. Which brings me back to one of my pet topics, which I have alluded to a few times on the channel, and that's the merits of allowing someone else to manage your investments for you. In Australia, you need to at least have an Australian Financial Services licence to be able to do that. Not sure whether that's the case in the US, but those who've invested in Burry's Scion Capital or Buffett's Berkshire Hathaway are in essence accepting financial advice from them. In the case of Burry, get out of the market as fast as you can. In the case of Buffett, just keep doing what we've always been doing. I would dearly love to be able to have a great stack of money to invest in the market on behalf of others, but I can't do that for obvious reasons. And why would I want to do that anyway? Well, it would be just about the easiest way to make $1 squillion without having to do too much work. Trying to outperform market indexes, such as the ASX 200 or the 300, is not necessarily easy. And while the content that I delivered when the channel was called Invest for the Future showed how you might go about that, it also showed how some well-researched and back-tested strategies don't always beat the benchmark against which they are compared. But since I started Invest for the Future in December of 2018, right through to the time that I needed to stop making content that could be interpreted as individual financial advice, the returns from investing in the strategies that I developed were well in front of just investing into broad market index funds such as STW or VAS. Now you're going to have to take my word for it, but the compound annual growth rate of the portfolio that I discussed on IFTF is 10.4%. It was almost 18% at this time last year, and so 2022 has been a salutary lesson about how the market can jump up and bite you if the strategies that you're employing deliver stocks that are not in the favoured basket of Mr. Market. High growth stocks were not the preferred flavour in the first 6 months of 2022, and so my portfolio has had to absorb some serious punishment. But every portfolio should be measured against an appropriate benchmark, And according to Stock Doctor, the average annual returns for STW and VAS, which are kind of the benchmarks that I compare myself with, if you include dividends over the last 3 years, the returns were 6.87% and 0.79% respectively. So in the end, I have to be happy with that 3% outperformance. Not staggering, but enough to have made the time spent on research worth it. But compared to some reasonably well-known managed funds, I'm somewhat delighted. On screen are the average annual returns for a range of funds, none of which achieved a better return than my portfolio. Now, I'm absolutely sure that there are some funds that have delivered the goods, so don't get me wrong, I'm not saying that you shouldn't use managed funds as one of your investment vehicles, but do your own research before deciding whether your fund of interest has the track record to warrant consideration. You can access information about the performance of managed funds at InvestSmart, and the link for that is in the video description. Okay, so why would I want to be a fund manager? Well, it's those management fees that attract me. I don't know how many billions of dollars are managed by these funds, but I reckon I'd be able to attract at least some to my managed fund given the historical performance described above. So let's say I find 100 people willing to entrust me with their investment dollars. On an average, they have a balance of $500,000. That's $50 million earning me management fees of say 1.35%. That's a cool $675,000. Okay, I might have to employ someone to manage the administration, and allowing for some other costs, I reckon that leaves about $500,000 for me. Not a squillion dollars, I suppose, but not bad. And once the word gets out, funds will start to pour in because of the performance of the fund, and I'll scoop up all of those disillusioned dollars that are exiting Magellan and Platinum. I can see a future with funds under management of $1 billion, and I'll then be ordering my yacht and Lamborghini for sure. Only problem is, I wouldn't be able to handle the stress of managing that much money. Also, there'll be some of my stocks I wouldn't be able to enter because of the size of the fund. And I certainly, last of all, don't want the responsibility. The final point that I will make, though, is that the statistics show that the majority of fund managers are not worth the management fees that they charge. The data on screen is sourced from InvestSmart, and while they are as at June 2019, I would be amazed if they were much different today, given the 3-year returns that I displayed earlier in the post. So that's it for today. With reporting season in full swing, I have been updating my patrons with the daily market reactions to company reports, and yesterday discussed approaches to rebalancing a portfolio and my thoughts on rotating capital rather than buy and hold forever. I do look forward to catching up with you again next Sunday, and until then, as always, stay safe and stay well.